All right, continuing on our How We Got Here series intro to our updated market analysis page or market updates page. Uh, Before we talked about the history of the 30-year fixed mortgage rate, the averages, and how it follows inflation, or actually just the history of really the last 50 years. That's where we had the data. We had all the data being reported and going back to the early 70s. So that's kind of the starting point for us. Now I'm just really looking back at the last year because what we had throughout 2025 was a steady improvement in mortgage rates, and of course, obviously, steady improvement in inflation. So as you can see here, this is the last year of average mortgage rates. We, going back a year ago, we were in, six and a half ish, mid sixes, the slow, steady downwards, which is what we want. We want consistent, steady gains or trends. And then what happened, in February, March time frame, that's when the Iran conflict started happening. Now, here's the important part to remember in this analysis is typically when there is some sort of a world event like that, a crisis or something, mortgage rates typically trend downward because investors will investors will sometimes push funds into safe investments like treasuries, mortgage-backed securities, stuff like that. Stuff that's almost guaranteed. U.S. treasuries are guaranteed. Mortgage-backed securities are the second safest investment. So that's what happens a lot of times. Now, the kicker that most people didn't see, and we were actually kind of surprised at the level of price shock, if you will, from the Iran conflict was the cost of oil. Now, let's go to this chart, which this is West Texas Intermediate crude, but it did, follow the same trends as the rest of the oil industry. When the Iran conflict started happening, not only did the supply of Iran oil, get that out of there. Not only did the supply of Iran oil get cut off or cut down quite a bit, but a lot of oil supply goes through the Strait of Hormuz, which, as of course I'm sure you've heard, that little choke point south of Iran and north of Saudi Arabia. Very, very narrow choke point, basically, for transporting oil because a lot of Gulf states are right up there north of the Strait of Hormuz. So they load up their ships with millions and millions and millions of barrels of oil every single day and transport all over the world. Now, so that is what happened with the cost of crude is these are futures, right? So actually you can see right now, today is August 26th. This is the October contract. So it's like the futures of what we think oil will cost in the future. So obviously oil prices shot up right away, immediately, right? And now, that was in the beginning of March. And now here we are, August 26th. Oil has come back down off of its highs, but still kind of trending right around $80 a barrel, depending on, where, up plus or minus a little bit. So oil obviously is a cost of a major cost, and or energy is a major cost in providing, delivering goods and services, manufacturing, the cost, go into the cost of producing items. So then obviously here is our next tab to share. This is the CPI, core CPI over the last year. And CPI is consumer price index and core is minus food and energy because energy, as you saw from the last slide, is very volatile, changes really quickly. When you strip out food and energy, it really takes a look at products that cannot change their prices very quickly. They cannot just willy-nilly increase or decrease their prices right away, right? Food can, because you have to transport the food, and so oil prices, energy prices correspond really heavily into that. And of course, food prices can go back down fairly quickly as well. But other items, they have to really evaluate whether they're going to raise prices or not. And what we found was, inflation rate kind of trending downwards all the way through last year, kind of holding. We're getting down into the mid twos, and we really want inflation to be underneath 2%. That's kind of what I would like. I would like it again closer to one. just to provide relief to people, but also we do need some inflation if there's a growing economy and whatnot. But that's a different discussion. And what we saw here was inflation March, April, May start to tick up a little bit. Now it didn't. Now the headline CPI that does include food and energy went up a little bit more than that, just because you're talking about increased oil prices. But the other goods and services, so the cost of you actually purchasing, clothing or whatever else, right? That are not related to, they're not direct food or energy. Those did not really go up a lot because they don't want to raise their prices right away and then lower them and whatnot. So a lot of companies, thinking that this was a temporary conflict, absorbed the increased cost of energy into their margins, knowing that, look here, in June and July, as we got rumors and words of the conflict uh, settling down, we heard peace talks all the time. Do I think there's going to be peace? There may not ever be an actual deal, but I also don't think that Iran has the resources to keep fighting anyway. So that might be done. Plus, the other factor that has actually happened is, and if you give private industry any kind of a window, they figure out a way to get through it, and so that's what's happened here. Um, I think it's Oman has figured out that they're going to open up ports on the opposite side of, because they have land on west and east of the Strait of Hormuz. So they are opening up and developing ports on the side that's already through the Strait of Hormuz, right? Instead of operating the port that they currently are operating. So bypassing the Strait of Hormuz, Saudi Arabia has opened up a pipeline that's 40 years old to transport oil from the north end of Saudi Arabia to the south, again, bypassing the Strait of Hormuz. We've also seen, I think, one country, I can't remember which country it is, left the OPEC nation. So oil producing export countries, I think is what it's called. Basically, the Middle East Gulf states all colluding together to make sure to keep oil prices the same. They all trade at the same level, the barrels of oil, which means that they can kind of, that whole group of countries can have a stranglehold on much of the world when it comes to oil, um, and the delivery of oil, the cost of oil, and whatnot, right? So that is another kind of a good byproduct of all of this, is that if all of those countries start acting independently of each other, then there is more competition in the market, because now you have 11 independent countries selling barrels of oil instead of one gigantic organization, keeping their price of oil either up or down, depending on what they really wanted to do to manipulate markets. So that's another for another discussion again, but another byproduct of this whole Iran conflict. Now, as we've seen here, CPI, core CPI has kind of come down a little bit because a lot of industries have not really made too big of adjustments. And then, of course, as some things do start to come down, transportation costs start coming down as oil prices have come down a little bit. So too does CPI. So if we go back now to our mortgage rate chart, as we can see here, I mean, it all correlates, right? Cost of oil went up, expected inflation went up, mortgage rates went up. So that's where we are, right? Fluctuated, trying to get back. Mortgage rates have tried to come back. Right here was, oh, everything must be over. It's definitely not. And we've kind of settled into this middle sixes range right now. And the next step from here is, if the Iran conflict is completely done, or if we know that oil producing countries can deliver oil more cheaply, then we know that inflation will keep coming down, and then mortgage rates should keep coming down as well. But again, important to note that a year ago in September, August, we had mid sixes, and then it was average mortgage rates got down in the low sixes by March. So that was really like a 6 month timeline right there. Same thing could possibly happen again here. So again, important to know that if you are thinking about purchasing a home and you're like, man, I really want that 6% rate again, it once everything is resolved, it takes time for it to work its way back down. So it's not an immediate fix again. It may take 6 to 9 months after that for rates to get down to that mark. Well, where we are advising clients at the moment is there are homes available with motivated sellers, and you might get a much better deal on a home itself if you purchase right now. So, every $10,000 that you go up in a purchase price, it's about $60 per month on the mortgage payment. So, yeah, would you save $150 per month maybe on a lower rate, a 6% rate, but is it going to be canceled out by having $120, $130 higher monthly payment because, you waited and now the market's a little bit hot again and the cost of that home is now 20 or 30 grand higher than what it was before because now it's a more stable market and sellers aren't having to cut prices as much. So that's the kind of what we're seeing right now is sellers are very motivated, especially in the areas that we work in Texas and San Antonio, much of Houston. Some parts of North Houston are still a little more balanced, but we're seeing buyers have more power right now. So that's kind of what we're encouraging. But that's how we got here for the first half of the year. We will do some more updates as we go on what we expect moving forward, but it just further emphasizes the fact that mortgage rates are following inflation. They are not reacting to what the Fed does. They are reacting to jobs reports, GDP a little bit. So these jumps here or there are from economic reports, or anything else kind of noteworthy in world news that might affect it day to day. But the overarching trend is going to be with inflation. So inflation is always going to be pulling rates one way or the other.